Welcome into my Vanguard portfolio update. Sit back, relax, because we've got a lot to get through in this episode compared to what we did just a month ago. I feel like every time I sit down to make these videos, everything just changes so quickly. So forgive me if we get another brand new news story that comes out, but let's have a look through what's been happening in the news, a bit of a recap before we jump into the portfolio itself. I always put timestamps below as well. If you do just want to jump into the portfolio itself and you're not interested in everything that's been going on in the global economy, feel free to skip. Anyway, let's just recap on the biggest story at the moment and let's talk about these tariffs. Now, if we just rewind the clock back, what feels like a lifetime ago, around a month ago, Trump was on the White House lawn with this big card and all of these tariffs that he was going to impose on different countries around the world. Now, these tariffs were got to by basically looking at the trade imbalance between the United States and all the different countries in the world. Now, a trade imbalance on its own is not necessarily a good or a bad thing. The United States, for example, as a very rich country, buys lots of products from lots of poorer countries. And it also buys products that it can't make itself. For example, it could be coffee beans, it could be vanilla pods, all kinds of wild things like that. Now, the reason behind these tariffs was seemingly that the US was being ripped off by lots of these mainly poorer countries. And therefore, in retaliation to this trade imbalance, the US would impose a tariff at half the rate that it calculated based on the trade imbalance itself. And this saw China being put right in the crosshairs at the top. Now, the markets reacted terribly to this, and I covered this in my last portfolio update, with up to $10 trillion of stock market value being wiped off from some of the biggest indices around the world. Many of your portfolios would have suffered in just a space of a few short days and over the next couple of weeks. Now, this was rowed back pretty quickly, and there was a pause for 90 days on these tariffs because there was just such an outcry from so many countries, so many businesses, saying really that they were going to destroy their businesses overnight if you were going to impose such large tariffs, because ultimately the tariff would be paid by the US consumer. The business importing those goods into the US, whether that be from China, different parts of Africa, South America, etc., would ultimately have to be paid by that consumer at some point, and many businesses would be scared to pass on that entire tariff. So those are rowed back or paused at least for 90 days, and all of the tariffs were paused effectively at 10% for every country except China. Now that ratcheted up where we are today. There's a 145% tariff on China from the United States, and then China retaliated with a 125% tariff, and they said they're not going to go any further, effectively putting the two parties in a bit of a stalemate. Then the next thing that happened was Trump also rode back and made some concessions on various other things like smartphones and technology chips, etc. Because you saw Apple actually flying in plane loads of their equipment before the tariffs came into play. No doubt lots of lobbyists in the background were having their say in making sure that Trump was fully aware this was going to harm their business significantly. So therefore, the tariffs need to be paused, because putting it into place immediately doesn't help anyone, and no one can get a supply chain fixed. Anyway, since then, the US and China have been in a bit of a standoff, although Trump and the Treasury Secretary Percent has actually said that a trade war would be unsustainable. And it looks like they're softening the language now, talking that they do need to have talks with China and work to some kind of conclusion. So that language and that rhetoric has been softening. So that's the latest update on that one. I'll put that story up so you can see that now on screen. Now, on top of these tariffs, this has led to some interesting things happening in the stock market. Where you would expect other areas of the market to rise in response to the stock market falling, actually we've seen quite the opposite effect. So there's two main things going on at the moment which you might want to keep an eye on. Now, the first thing you can see is actually that bonds have sold off as well as stocks. Now, traditionally, you would see bond rise as stocks fall and vice versa, as people are looking for a safer asset. And one of the safest assets has been, in the past at least, US bonds, a trustworthy government with a currency which is the global reserve currency. So investors would be buying into the likes of a 10-year treasury, for example, to get a guaranteed fixed income for the next decade. Now, because of all the flip-flopping, going back and forth and rowing back of things, the US at the moment is being seen, at least from lots of countries, as an untrustworthy partner, or a partner where really they're quite unpredictable. So you would have actually seen that lots of bonds have been offloading. Now, what this causes is the yield of those bonds to spike up. Now, there's an inverse relationship between a bond yield and the price of a bond. Something it's quite difficult to get your head around, but once you do, you understand how things work. Now, bond yields are so important because the US government actually needs to use the bond market to borrow money and basically pay for lots of the functions and invest in itself. So the higher that bond yield, effectively the lower the cost of that bond, is a bad thing for them when they're looking at borrowing. And it's a similar story here in the UK when you hear lots of people talk about the fact that people crash the market, etc. It's really talking about that bond market and talking about the fact that when we see those bond yields rise, it really just means that borrowing for the government becomes a very difficult thing to do and actually becomes a much larger part of our expenditure paying down that debt. So that's not a good thing. Now, there's been fears the likes of China has been selling off lots of their debt because they own lots of US debt, and also countries like Japan as well, as you can see here, offloading lots of debt, unsure really of the US's ability to pay and really not wanting to put money there. Maybe there is some retaliation going on and using the bond market really as a signal of how people are very displeased with what's going on at the moment. But it's an interesting thing to look at. Now, a second thing you would have seen is actually the US dollar has been devaluing against other currencies like the euro and the pound, for example, if you just have a look what's been going on. Now, this has a couple of effects, but it effectively means that imports become more expensive, but exports cheaper. Now, for us as investors from the UK, it actually makes US stocks and US products actually a little bit cheaper. And if you just have a look here, I'll show you as a good example of just how the effects this has on our investment. So, for example, as you can see now, from mid-January until today, the pound is nearly 10% stronger. Now, that's a huge swing if you actually have a look at this. Now, from an investment perspective, let me show you what this could have an effect on. So I'm just going to compare now two S&P 500 index funds, one which is actually hedged against the dollar and one which is just going to float automatically against it. So let's have a look at GSPX versus VUSA, just to give you two examples. Now, GSPX is the one which is hedged against the dollar and VUSA isn't. So you can have a look at this one over different short-term time frames and you can see the difference that this can make to your investments. Now, I don't advocate jumping around or necessarily looking at hedged investments, but it is really interesting to know that the dollar, because so many of the investments that we buy are in dollars and the US is the biggest dominant stock market, that pound to dollar conversion does play an important role. And in the short term, it has a very big impact on our investments. And in the longer term, it might have a less impact, but it's really interesting to at least look at that as well. Now, talking of other assets which are meant to be that safe haven as a store of value, gold has actually been holding up really well. And you would have seen it in the headlines multiple times. And I covered this in my last portfolio update, that gold just keeps going to all brand new highs as investors are really looking for that safe haven, some kind of store of value, whether that's not traditionally in the bond market or neither is it in the stock market as well. Now, just as I'm recording this, though, gold has had a bit of a pullback as the market has had a bit of a rally, at least over the past 24 to 48 hours, with signs that actually the US again is making some more changes. Now, one of the biggest falls you would have seen recently is that stock market crashed down because Trump is calling for the resignation, or calling really to fire the chair of the Federal Reserve, Jerome Powell. Now, this is not something that Donald Trump has the power to do, but he's still going to make those statements to say that he doesn't have faith in Jerome Powell, and he wants Jerome Powell to cut interest rates to effectively make borrowing cheaper as a way to stimulate the economy. Now, this is quite a weird thing to suggest because the Federal Reserve is meant to be independent from the government, and actually it's really important that the Federal Reserve remains impartial and effectively apolitical from the government, because you don't want governments coming in effectively making monetary policy in the short term, at least, causing huge spikes in inflation or deflation and the next government having to come into place. You really want that dollar, which is the global reserve currency, to be stable, and you want them to be able to make decisions outside of that. Anyway, the president does not have the power to do that. He's now rode back that after the stock market absolutely tanked, after him suggesting that he could remove Jerome Powell. So he's now said that he won't fire him, even though he can't fire him technically anyway. It's funny what's going on at the moment. It's like you were punching someone and then blaming that same person for making your hand sore and then trying to say that the other person is at fault, or maybe something like that. I need to get some better analogies sometimes. Final news story I'll just highlight now is the IMF putting the US growth and really reducing the level it expects a forecast for US GDP growth. However, I take these with a pinch of salt because not only were these put together when the tariffs were first announced, but really none of us can know what is going to happen in the future. And I think that's going to lead me on to what I'll talk about in the portfolio update. But I think all of these forecasts are really totally irrelevant because they're reacting to events and short-term events which can basically be pulled back or flip-flopped on as we've seen over the past few weeks. So there's no point making a large long-term economic forecast for any country when these tariffs, for example, could just disappear overnight, get negotiated away, and basically we go back to where things were. But anyway, it's an interesting story, and it's more interesting really of how it gets reported in the news media, as if it's like some big thing, someone saying, oh, the US might not grow as much. Well, really, there's no way to know what will happen to the US unless things change so often. There's no way to know. But it's funny how people spend so much effort trying to forecast a future that is unknown. Right, it's time to actually jump into the portfolio itself. Let's see what the damage has been over the past month. And I'm expecting things to not look quite rosy. And I think we may see the last month being really the worst this portfolio has ever seen. But let's touch on what that actually means in just a second. So on my Vanguard platform, I really hold two accounts, but one is the main one, which is my pension, as you can see here. Current value is at £78,641, just a very small gain, holding onto the green at £4,087. If I have a look here in the investments tab, I'll go and have a look at the performance to confirm my suspicions that actually we've had the worst month, at least that I've ever seen in this portfolio since putting it together. So if I have a look here in the performance tab, and then I go down to month, I'll see just how bad the last 30 days has been. It's quite funny, as I record this, we've still got a few days left in April, so anything can happen. But as of now, you can see these horrible 3 red months here: February, March, April. April so far down £5,805, at least on value, if I were to sell everything. Now that's going to be a first point that I need to bring up, and I'm going to bring this up time and time again. The green and red numbers to me in this portfolio mean absolutely nothing, because they only should mean anything really to you if you were going to sell or buy investments right now. Really, I would say buying them makes no difference at all if you're a long-term investor. It's only really if you're selling them that where the value is important. And I keep coming back to this story about the value of your house, which can change every single day. But because unless you actually need to move house, the value of your property doesn't mean anything. But it's purely a psychological thing, where if you thought your house was worth twice as much as you kind of think it is now, but on the market it's, you know, twice the value, great. You might feel great and you have a good day and everything. You might spend more money, for example. But the moment you think your house is worth loads less and you're in negative equity, then you start thinking negatively. But it doesn't change anything about your normal life. And it's the same way as my investments. And actually how we get through these bad times should really reflect on our performance later on. If we only invest during amazing times and the market's only going to go up, then that's great. But we're not going to perform very well if we only invest during those good times and we don't invest during the bad times as well. And anything can happen in the short term. The market has been so volatile recently. We've had huge swings where everything's euphoric again, and then everything's seemingly negative. Now, I don't let this affect my investing decisions whatsoever, but I am afraid that many beginner investors and many people out there who claim to be investors really are timing the market and trading. Anyone buying in and out at the moment is really just gambling and speculating, and there is no reliable way to be able to time the market. Yet, unfortunately, many people just keep on doing it because apparently they know better. And I'm almost grateful for those people, really, because they make the market how it is, and we do need an active market, but no one can do it reliably enough. And there's very few people who've had any success doing it. And there's no way to distinguish between skill or luck, really, over that longer time period. And many people will convince themselves that they're really, really good at this. But anyway, now just going back on a choice of investments, many regular viewers will know in this portfolio, at least, my self-invested personal pension is a single global index fund. So remember, I'm just tracking the global market. So I'm just following where the money is. So my money gets invested across all of the different countries around the world and all of the largest companies in the world, depending on their market cap. So as they fall, less money will get put into those. And as they rise, more money will get put into those. And it'll be the same in every different country. At the moment, as the US is having a pullback and a correction in their stock market, more money will be allocated to other countries in the world where some of their companies are actually having a bit of a better time. Now, this also leads me on to another topic that I did mention in the news part, and really one of the biggest assets which has been doing well at the moment has been gold. Now, in the short term, any asset can perform very, very well. And just because an asset has done well in the past, it does not mean an asset has to do well in the future. And my fear on things like gold and other assets or individual stocks who've done well and weathered this storm so far is that lots of people will assume that this will continue, and lots of people will chase those returns because they want them in their portfolio. And I think this is a very foolish thing to do. Now, already we've seen a pullback in gold because of the pullback in tariffs and the cooling down of some of the rhetoric going on. And I fear that a lot of people would have put a lot of their money or allocated a lot of their money to gold, and they may have performed well, for example. But the question will always remain, okay, well, how long are you going to hold on to this thing? Gold in the long term, like any other commodity, it does not produce any cash flows at all. It doesn't produce profit. It can't outperform. It can't produce a new product. It's not a business, and it's not something designed to grow your wealth. And it may grow your wealth if you get lucky and time it right. But over the long term, gold will never beat the likes of equities, likes of stocks, for example. So I'm always cautious about people jumping in and out of things. And this also applies to any individual stock too. There's no saying just because a stock has performed really, really well over the past 5 years or 10 years, for example, that it's going to continue to do that. And in fact, most stocks who performed extremely well end up really performing average because they revert to the mean. No stock, for example, could ever deliver 20% year-on-year return forever. It would then, be larger than the whole of the global economy. So you just have to be really careful during these times. And I think the biggest thing really for me that I'll keep reiterating in all of my videos is, as a long-term investor, you have a superpower. And that superpower is that you do not have to react to the day-to-day moves of the markets. The traders at the moment, and there are plenty of people I'm sure who are going to be making a killing, are having a whale of a time. But there's also going to be many, many losers out there on the other side of that trade. Remember, in the short term, it's a zero-sum game. Ultimately, you've got two parties, one person buying, one person selling, making some money. One person who's making money is only making money because another person is potentially losing it on the other side of that trade. And in the middle, you have all the platforms and the brokers and the apps and market makers, for example, who are making a killing and they're loving all of this volatility of selling out of their traditional investments and moving to gold, and they're just absolutely loving things at the moment. But as a long-term investor, you do not have to get involved in any of this. Now, it's good to know and good to understand, I think, what's going on in the market so you don't panic. But making changes based on short-term things, which, this is a short-term thing, whether that's for 6 months, 1 year, 3 years, 5 years, doesn't bother me. I think, honestly, by the end of this year, I think we'll be looking back at what happened at the start of this year and we'll just be laughing about it. And I'm actually looking forward to making my annual recap when we go to the end of 2025. Because I think it will just be an interesting one. And the tariff story, for example, will just be one of the stories that will come up. There'll be plenty more crises that we'll talk about over the next few months, 3 months, 6 months, 12 months, etc. But changing your investing habits, in my view, is just extremely foolish. Timing the market, jumping out and waiting to get back in, time and time again, every single professional investor that you ever speak to who's done well over the long term will always tell you not to time the market, not to jump in and out. Yet people consistently do this. Unfortunately, it's very, very easy to do this nowadays. And as much as I love the new investing apps, how they're so cheap and free and easy to get involved in, it also means that you have to control yourself too. And it all comes back to that key topic of human psychology. That you, looking at me now, you stupid chimp monkey brain human, ultimately are going to be your own worst enemy when it comes to investing. So you've just got to rein that person in, stick with your plan, expect anything you invest long term to not need in the short term. And if you do that, you should do pretty well. But there are no guarantees in this crazy ride that we call investing. Anyway, that's my thoughts and that's been my update. I'd really, really be interested. Let me know how you're all getting on in the comment section below, especially if you've just started investing now. I want to understand your thoughts and feelings. Are you actually pleased? I mean, if anything, if you started in this new financial year, you should really be thanking yourself, right? Because April the 6th and the 7th was actually a pretty good time to invest. When we look back already, you're going to get some pretty good low points of the market. And over the long term, though, I genuinely don't think it really matters. As you can see, back in my portfolio, I'm going to invest every single month without fail. And in a couple of weeks' time, when we cross over to the next month, more money is going to go in and I contribute my money from my limited company and it's going to go into the same fund, no matter what happens to the global stock market. But please do let me know what you're doing down below. Reassure other people. Confirm to me that you're actually sticking with your plan. You're not panicking. But either way, let me know. I'll see you in the next video. As always, happy investing.